Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Hannah Chu, Portfolio Strategist with the Chief Investment Office here at Standard Chartered, and a very big welcome to our weekly podcast, Through the Noise. So joining me on today's podcast is Raymond Cheng, Chief Investment Officer of North Asia. So hi Raymond, thank you so much for joining us today. So as you might know, it's been another eventful week in global markets where headlines have pretty much been dominated by concerns over a prolonged US government shutdown. And meanwhile, we've also seen US-China trade tensions. They are back in focus. We've seen both sides signaling tougher stances on technology and investment flows. It's really reminding markets that, geopolitical risks are never far from the surface. But yet, despite the macro noise, I think there are pockets of resilience that we've seen in the markets. So we are going to unpack what all of this means for markets, for positioning, and where the opportunities might lie next. So Raymond, again, welcome to the podcast. I think let's start with the most obvious question, which is on the US-China trade tensions that has jolted markets yet again. So we've seen US President Trump proposing to impose 100% new tariffs on imports from China from 1st of November, citing China's latest rare earths import controls. So how are you thinking about it? And, what kind of impacts might we see on assets like US equities? Are there any other factors that we should also be aware of?
Thanks, Hannah. It's a great question to start off our discussion. We expect the US and China to reach a trade truce again. Now, both sides have enough economic leverage. The US has advanced semiconductor chips, while China enjoys a dominance in terms of rare earth supply. Now, this should help to prevent trade tensions from spiraling out of control. Additionally, Treasury Secretary Bessent raised the possibility of a longer-term truce should China relax its strict rare earths export controls. The two sides appear to be positioning for the planned Trump-Xi meeting in South Korea end of this month. There are several near-term risks that we are watching out for, such as stretch equity positioning and U.S. government shutdown. If we look at the combined investor positioning in U.S. equities, that has remained a 1.75 standard deviation above historical average. If we look back since year 2010, this has happened over time for about 11 occasions. Now, during these occasions, at such levels, right, upside for the S&P 500 index usually was capped at mid-single digits for the ensuing 4 months, while the risk of a 5 to 10% correction rose significantly. Now, given such stretch positioning, a prolonged US government shutdown, which is now in its third week, could be a catalyst for short-term pullback in US equities. That said, we do expect the shutdown of the government in the US to be eventually resolved. Now, we have also been saying that US earnings should be supportive of risk assets. Solid earnings and revenue beats from top US banks over the week have set the stage for another robust Q3 earnings season. Consensus expects the S&P 500 earnings to have risen 9.2% year over year in Q3, up from 8% estimated in the beginning of the quarter. Now, we expect the technology and communication services sectors to outperform on the back of strong AI-driven revenues. Guidance on the impact of tariffs on margins and the sustainability of AI capex and orders will be closely monitored. Now, for now, we would add to US equities on any pullback, particularly around the S&P 500 support level of 6250. Now, medium to longer term, investors can also consider adding to our preferred defensive growth sectors, such as US healthcare in changes to benefit from the short-term volatility. And lastly, we'll also add to the US tech sector on a further 5 to 10% dip.
Oh, that's great. Okay, what about China equities then? We've seen that there is the upcoming fourth plenum in China is scheduled to be held early next week. So how does this, as well as the trade tensions with the US, impact China equities in your view?
Yes, the focus of the fourth plenum will be on accelerating economic growth through technological advancement, specifically through AI plus strategy with the goal of achieving self-reliance in advanced chips and also migrate upwards along the international supply chain. Officials also stressed the importance of high quality development rather than quantity, highlighting the need to boost services consumption as a domestic growth engine. We remain overweight Chinese equities within Asia ex Japan. Valuations there remain reasonable, and we are constructive on sectors such as consumer discretionary, technology, and communication services, supported by sustained investment in innovation and industrial upgrades. Furthermore, potential monetary easing in China enhances the appeal of high dividend non financial state owned enterprises H shares in Hong Kong, which remain as one of our key opportunistic ideas. Now, our base case is no significant escalation in trade tensions, which ultimately lead to a meeting in APEC summit in Korea between the two nations or an extension of the trade truce. Now, Trump is now facing an impossible trinity, after all, in our view. That is, issuing counter threats of raising tariffs on China, soothing the slowing US economy, while having the Fed cut rates without fear of the return of inflation. Now, so, after all, our recommendation is for investors to charge in to the Hang Seng Index at around 24,500 with an initial tilt towards the high dividend non-financial state-owned enterprises H shares in Hong Kong.
All right, so we've talked a lot about equity exposures in both the US and China markets, but what about the impact on currencies? I think usually in times of uncertainty, we see investors, turning their attention to safe haven assets. So maybe what are your views on the currency expect?
Yeah, the Swiss franc would be a key currency to highlight here. The bearish bias on the US dollar Swiss franc amid the dollar weakness continues as Fed Chair Powell expressed the need to adopt a delicate balancing approach in upcoming policy meetings amid steady growth, with increasing challenges facing employment and inflation. Several other Fed governors also signal support for rate cuts before the year end. Now, meanwhile, the Swiss National Bank remains reluctant to return rates to negative territory. Unless the Swiss economy worsens notably, the policy rate there is likely to stay at around zero, supporting the attractiveness of the Swiss franc. However, we believe the Swiss franc could be under some upward pressure risk if the Swiss National Bank continues to watch for excessive strength and results in some potential intervention risk. So on that note, we are tactically bullish on the euro versus Swiss franc.
All right, maybe let's shift gears to bonds. So could you also share some of your thoughts around the views on, maybe EM local currency bonds? I mean, we have seen more of a risk-off tone in the markets, and we're also seeing a bit of moderation in the EM bond fund inflows and also near-term momentum. So maybe how are you still viewing the asset class as of now?
Yeah, indeed. To your point, right? Market sentiment has turned more cautious given geopolitical tensions and uncertainties around the US economic data. But we view this as a transitory pause rather than a reversal of the broader constructive trend for emerging market local currency bonds. Now, we still expect the US dollar to weaken over the next 3 to 6 months' time. And we've also seen improving fiscal resilience in emerging markets. The US growth premium compared with other regions has also narrowed, which should reduce the relative appeal of US dollar denominated assets. Therefore, in short, we still hold a constructive overweight view on emerging market local currency bonds.
All right, maybe just one last question. Maybe any other opportunities that you see worth highlighting this week?
Yeah, we have also been recommending an opportunistic idea on the UK government bonds for quite some time. We have indeed seen a rally in the UK government bonds gilt of late, and we remain tactically bullish there. We believe the Bank of England could prioritize supporting economic growth over the long-term 2% inflation target. Now, following a mixed set of August job data, we anticipate the UK domestic job market to weaken further, as reduced labor demand is likely to slow employment growth, while increased labor supply would put downward pressure on wage growth. Now, this should ease inflation risks in the UK, allowing the Bank of England to ease monetary policy. The nominal interest rate differentials between gilts and UK government bonds also remain quite elevated compared with history. Expected Fed rate cuts will likely widen the yield advantage of the UK government bonds over the US counterparts, making gilts look even more attractive.
Wow, thanks so much, Raymond. I think there is a lot for us to think about and to digest, but maybe if I can just offer the summary of into three key takeaways. So first is that we do expect the US and China to reach a trade truce. And while excessive bullish investor positioning and the US government shutdown, those pose as near-term risk. But I think we're also seeing solid corporate earnings and the trade truce that should continue to provide support for US equities. I think secondly, the team also seems to remain overweight on Chinese equities within the AHJ region, given that valuations still remain quite reasonable, and on the trade front, not really expecting significant escalation. And I think just lastly, in terms of tactical opportunities, the EM local currency bonds still offers quite attractive inflation-adjusted yields, and the team also is overweight on this region, on this asset class. And I think just lastly is UK gilts also continue to look appealing even after this week's rally. So I think that's all we have for today. Thank you, Raymond, again. And of course, thank you to all our listeners for joining us today on our Through the Noise podcast. Please do like and subscribe if you've enjoyed today's conversation, and we look forward to speaking with you again next week. Thank you.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.